Welcome to This Explainer. Today, we're unlocking one of the absolute most powerful risk management tools used in global financial markets: options. If you've ever looked at institutional fund managers and wondered how they navigate massive market turbulence without breaking a sweat, well, you're in exactly the right place. We are going to decode exactly how options act as strategic portfolio insurance.
Think about it for a second. How do massive funds survive a sudden, brutal market crash without having to panic sell their assets? When billions of dollars are literally on the line, you can't just hit the sell-all button the moment the geopolitical landscape gets shaky. Doing that would cause a catastrophic market impact, not to mention incur absolutely massive tax liabilities. So what's the secret weapon they use to survive the plunge?
To illustrate this, we're going to use an anchor example straight from the CFA Level 1 curriculum. Imagine a fund manager who is responsible for a massive 100 crore rupee equity portfolio tracking the Nifty 50 index. This is a huge sum of money, deeply tied to the broader market's performance. Keep this 100 crore portfolio in the back of your mind because it's going to be the centerpiece of our whole journey today. Here is our roadmap. We'll start with the institutional dilemma, build our foundation with options basics, compare rights versus obligations, decode how premiums are valued, and finally, bring it all together with a protective put strategy.
Let's jump right into Section 1, the institutional risk dilemma.
Picture our fund manager with that 100 crore rupee Nifty 50 portfolio. Suddenly, geopolitical uncertainty strikes. The manager looks at the data and genuinely fears a short-term 12% market crash is imminent. But here is the dilemma. Selling off the stocks? It's just not an option. They want to hold these assets for the long term, they definitely don't want to trigger capital gains taxes, and they need to avoid massive trading costs. They're absolutely trapped between the desire to hold and the sheer terror of a massive short-term loss.
Okay, let's dive into this with Section 2, Options Basics, Calls versus Puts. So an option is a specific type of derivative contract. By definition, it gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, before or on a specified future date. Now, I want you to mentally highlight the phrase right, but not the obligation. That is the absolute secret sauce of options. Unlike forward or futures contracts where you are literally forced to execute the trade regardless of market conditions, an option gives you a choice. Within this framework, there are two distinct flavors. First is the call option. This gives you, the buyer, the right to buy an underlying asset at the strike price. You generally buy a call when you expect the market to go up. On the flip side is the put option. This gives you the right to sell an asset at the strike price. You buy a put when you expect the market to go down, or, crucially, when you want to protect the assets you already own from losing value. Buying rights versus selling rights, that is the fundamental split. Let's keep moving. Section 3. Demystifying rights and obligations.
It takes two to make a market, right? For the option buyer, because they paid cash for the contract, they hold all the power. They have the right to execute the trade, and their risk is strictly capped. The absolute most they can ever lose is the premium they paid to buy the option in the first place. But consider the option seller, also known as the writer. They collect that premium up front, but in exchange, they take on the obligation to fulfill the contract if the buyer decides to exercise it. Their potential for loss? Depending on the trade, it can be massive. This stark asymmetry is what makes options incredibly unique.
Which brings us to Section 4, Decoding Option Premium Value. Now, what's really interesting about this is the math behind it, and we can do it without any complex algebra. If you buy a call option for a premium of 28 rupees, where does that number actually come from? It's split into two buckets. First is intrinsic value, the immediate built-in profit if you exercised it right this very second. If the stock is currently at 120 rupees and your strike price guarantees you can buy it at 100 rupees, you have an immediate built-in value of 20 rupees. The second bucket is time value. If your total premium is 28 and 20 is intrinsic, that remaining 8 rupees is literally just paying for time. It's the cost of the flexibility and the possibility that the option might become even more profitable before it expires.
All right, we have all our building blocks. Let's head into Section 5, the protective put strategy.
So the crucial point is applying this to our manager with the 100 crore rupee portfolio tracking the Nifty 50, who's terrified of a 12% crash. Here is the exact playbook they use. Step 1, keep holding the portfolio. Don't sell a single stock. Step 2, buy Nifty put options. Remember, a put option gives the right to sell at a predetermined price. Step 3,
Treat the upfront cost of those put options, the premium, exactly like you would treat an insurance policy on your house or your car. They are actively spending a little bit of money now to put a hard, unbreakable floor under their potential losses. Let's see this in action.
Here is case 1. The nightmare actually comes true. The market crashes by 12%. The 100 crore portfolio takes a massive, painful hit in value. But because the manager bought put options, the right to sell at the higher pre-crash prices, those options suddenly become incredibly valuable. The put option generates a significant gain, and this gain perfectly offsets the catastrophic portfolio loss. The portfolio is saved.
Let's move on and see how this builds into case 2. What if the manager was wrong, the geopolitical tension fades, and the market actually rises? Well, the portfolio goes up in value, generating a great return for the fund. But what about the put options? Because the market went up, nobody wants to exercise the right to sell at a lower price. The options just expire worthless, and the manager loses the premium they paid. But think about it. Are you angry when your house doesn't burn down just because you paid for home insurance? Of course not. The premium was a small price to pay for peace of mind while still capturing the market's upside.
And this brilliantly illustrates our main takeaway from the source material today. Options provide asymmetric payoff and portfolio insurance. We've seen exactly how they cap your downside risk to just the cost of a premium, while allowing you to maintain literally unlimited upside potential on your underlying assets. Whether it's a massive fund managing billions or a jeweler protecting the value of their gold inventory, options are fundamentally about risk management, not just wild speculation.
You've seen how the biggest players in the world use these tools to protect their wealth from sudden shocks. They don't just cross their fingers and hope for the best. They mathematically lock in their downside. So, looking at your own financial strategy, I'll leave you with this question. Is your portfolio properly insured? Thank you so much for joining me on this explainer. Keep learning, and I will catch you next time.